Hi, everybody. I'm Brian Ullman. I'm a financial advisor and managing partner here with Ford Financial Group. And I want to thank you for joining us today to talk about savvy IRA planning for baby boomers. We do webinars pretty consistently for our clients here at Ford Financial Group. But while we are on our end of summer, beginning of fall break, we didn't want to stop the education right here. We wanted to continue to be able to put together some programs for clients of ours or people who might be interested in becoming clients of ours, so you can learn a little bit more about what's going on with your finances. And so that's why we're doing this recording today, so you can watch it on your own time at your leisure and learn a little something about IRAs and getting the most out of your IRA. Because a lot of people have a plan for accumulating money in retirement, adding money to your 401k or an IRA or 403b, something at work, saving for your kids' college. But far too often, that's where the planning actually stops. And that's not good enough. Planning to save is one thing, but we have to figure out that how a sound distribution strategy, so a plan for taking money out of your retirement accounts, folds into your overall plan, because it's just as important as saving, if not more so. And so that's what we're here today to address for you. If you have questions as we go along, because we're not doing this live, we're doing this as a recorded presentation, you can email us at info@fordfg.com, and we can forward your questions on to your advisor here at Ford Financial Group. Or alternatively, if you're not a client, we can have someone reach out to you and answer those questions for you to see how Ford Financial Group might be a good fit for you and the questions that you have for your retirement accounts. So let's dig in a little bit and kind of get started with some of the common questions here, because when it comes to your IRAs and other retirement accounts, frankly, you probably have a lot of questions like, how much are my withdrawals taxed? When do I need to begin taking withdrawals? How much do I have to take? What happens to my IRA after I die? And maybe most importantly, how can I minimize my taxes so I can spend more of my hard-earned money? And those are all good questions that we're going to try and address here today. So as we go through those questions, I'll just tell you a little bit about myself. There's a lot of writing on this slide, but quickly, again, my name is Brian Ullman. I'm a financial advisor here at Ford Financial Group. I've been here for around 15 years. I also practice as an attorney before being a financial advisor here at Ford Financial Group. I do not practice any longer. Instead, I spend most of my time here working with clients and in my spare time, spending time playing tennis with the rest of my family. So anyway, that's a little bit about me. I know that my little picture in the corner maybe goes over the bio, but if you'd like to see the slides from this presentation, we can do the slides here. You can email us at info@fordfg.com and we can do the slides. I'll make my picture a little bit smaller so we can really get into the slides here, because I think the difficult part here is that years ago, life was simpler, and in many ways, retirement really wasn't any different than that either. It was simpler. Many people went to work, and then when they retired, they collected a pension and Social Security benefits. There wasn't as much needed in the way of planning, and people weren't all that concerned about running out of money, since both their pensions and their Social Security benefits were generally guaranteed. And for most people, that, along with whatever else they'd managed to save along the way, was enough to bridge the gap in retirement. Today, things are a bit different, and I would say, like many things these days, a bit more complicated. Companies and other organizations have really abandoned pensions in mass numbers and instead have turned to 401ks and similar plans that shift many of the risks that the companies once shouldered onto the backs of employees and their families. So retirees are now responsible for making more of the critical decisions that will determine how successful they are in retirement. And that includes keeping up with changes in the law, which happen all the time. In fact, for instance, just at the end of 2019, the Setting Every Community Up for Retirement Enhancement Act, say that 3 times fast, known as the Secure Act for short, made a number of really significant changes to the rules for retirement accounts. A few of those we're going to walk through today. But the bottom line to all of this is that today, more than ever, when it comes to your retirement, you are on your own. Your company or your business is not managing a pension for you. It is up to you. So on top of that, your retirement savings may have to last you a lot longer than you think. According to a 2011 Society of Actuaries report, over 40% of retirees actually underestimate their life expectancy by 5 years or more. If you take a look at the chart that we've got here on the screen, you're going to see what I mean. If you're a man and you're 65, you have a pretty good chance of living to at least 85. If you're a woman and you're 65, you have a better chance of living past 85 than you do than dying before it. You're more likely than not to live past 85. The numbers get better if you're married. If you're married and both you and your spouse are 65, there's a strong chance that at least one of you will live to age 90. In fact, there's about a 33% chance that at least one of you will live to be 95. And so what that means is that your retirement savings could easily have to last you 20, 25, 30 years or even longer. And that's probably much longer than many, if you're watching this, than you've considered. So you put all this together and it makes having a plan all that much more important. One of the things that I like to tell clients is that at this point, given our longevity, you may spend a third of your life in your retirement, which is much longer than people were spending years ago, especially like when Social Security was established. Retirement was a number of years, not a number of decades. So keep that in mind. And one of the best things that you can do as you approach retirement, if you're not already there, is to beef up your retirement savings. You do that by contributing as much as possible to tax-favored retirement accounts. Although now contributing at younger ages is more powerful because it gives your contributions more time to compound, and you may have been unable to save as much as you wanted because you were bogged down when you were younger with mortgage payments, saving for kids' education, or other expenses associated with raising a family. One of the things we hear more often than not now, student loans, which has been in the headlines here lately. But chances are, if you're watching this, you really probably you certainly don't have all of those expenses. You don't have many of them, or if you may not even have a mortgage or anything like that, or it'll be ending soon. So as a result, you may have finally some discretionary income that can be used to fund your retirement accounts. So that leads to the question, just how much can you contribute? Well, that depends on the type of retirement account, as well as a few other factors. So let's begin here with the traditional IRA. A traditional IRA, it's short for an individual retirement account, is a personal retirement account that offers certain tax benefits. So contributions might be tax deductible, and while your money is inside the IRA, it grows tax deferred. So ultimately, when you take money out of your IRA, the amount you take out is generally added to your income. So we'll talk about that a little bit more later. But understand, if you take money and you put it into an IRA, you don't pay taxes on that now, and you don't pay taxes on the growth. You are taxed on it later down the road when you take money out of the account. Now, in 2022, the maximum you can contribute to a traditional IRA is $6,000. But if you're 50 or older, by the end of the year, like most people probably watching this, then you're allowed to make an additional $1,000 catch-up contribution, making the maximum you can contribute to an IRA for 2022 is $7,000. So $6,000 if you're under 50, if you're 50 or older, there's a catch-up provision making it $7,000 a year. Now, you can't always make a traditional IRA contribution, though. So, for instance, if you make a traditional IRA contribution, you must have what the tax code refers to as compensation. So for most people, compensation is earned income, but it includes a number of other types of income like taxable alimony. It doesn't, however, include things like interest, dividends, capital gains, Social Security benefits. I get asked that question a lot. And it doesn't include unemployment compensation either. So most of the time, if neither you or your spouse works, you won't be able to make a traditional IRA contribution. Now, in the past, age was also a barrier that prevented some people from making traditional IRA contributions. And such contributions were prohibited once an individual reached the year that they turned 70 and a half years old. Now, the Secure Act that I mentioned a little bit earlier, it eliminated that age-based restriction. So as a result, if you have compensation, you can make a traditional IRA contribution, period. So if you still are working or are you self-employed or something along those lines, you can still make IRA contributions regardless of your age. And traditional IRA contributions are deductible unless you or your spouse are active participants in an employer-sponsored retirement plan and your income exceeds an applicable threshold amount. And those limits depend on your filing status and who's contributing to an employer-sponsored plan. Now, if you're watching this, you probably know that there's another type of IRA called a Roth IRA. Roth IRAs are similar to traditional IRAs in many ways, but there are also some key differences here. And one of those differences is that you don't get a tax deduction when you make a Roth IRA contribution. Once your money's in a Roth IRA, it grows tax deferred like it does in a traditional IRA. But the big benefit of the Roth IRA, and another key difference between it and a traditional IRA, is that a Roth IRA distributions can be tax-free in retirement. So if you've had any Roth IRAs for more than 5 years and you're over 59 and a half, then all the withdrawals that you make from your Roth IRAs will be tax and penalty free as part of what's known as a qualified distribution. Even if you need to take a withdrawal sooner, you can always take it out of your Roth and contributions, your Roth IRA contributions, tax and penalty free. One of the accountants that we work with here loves Roth IRAs. He says it's better to pay the tax on the seed than the harvest. And I have to agree, conceptually, that makes the most sense. Although your circumstances might be a bit different, depending where you are in your career, what your tax bracket looks like right now at the moment as you make those contributions. Now, some of the same contribution rules that apply to a traditional IRA contribution also apply to Roth IRA contribution. So, for instance, the same $6,000 contribution limit applies. And similarly, if you're 50 or older by the end of the year, the contribution limit is increased to $7,000 because of that $1,000 catch-up contribution. Now, Roth IRA contributions are also subject to the same compensation rules as traditional IRAs. So if you have sufficient compensation, then the only thing that would prevent you from making a Roth IRA contribution is having too much income. So you can see the income limits here on the screen. If you're a single filer, as long as you have income under $129,000 a year, you can make a full Roth IRA contribution. And similarly, if you're married and file a joint return, then as long as your joint income is under $204,000, you can make a full Roth IRA contribution. So while some baby boomer couples retire at the same time, oftentimes one spouse retires before the other. And in those cases, you might be able to take advantage of a spousal IRA or a Roth IRA contribution. And these are special contributions that allow a spouse with compensation to make a contribution to the traditional IRA or Roth IRA of a non-working spouse. So in other words, the non-working spouse can use the working spouse's compensation as their own for contribution purposes. And the spouse for whom the contribution is being made, they must meet all the other contribution rules applicable to that type of IRA. So one spouse working, one spouse not working, that can still count as qualified income that would allow you to set it aside in a Roth or traditional IRA, provided that you're following some of the other rules there. Now, you might be asking yourself, can a $7,000 contribution really make a difference when it comes to my retirement? And the answer is, yeah, absolutely it can. So here's a quick example. Suppose you're 55 years old right now and you plan to retire in 10 years at age 65. The kids have flown the coop and you finally have a chance to focus on saving for your retirement. So if you make a full $7,000 Roth IRA contribution annually until you retire, that's going to make a huge difference. So if you earn, let's say, 6% per year on that contribution, then by the time you retire in 10 years, you'll have close to $100,000. Now, remember, you might need to plan on living until age 90 or 95 or perhaps even longer. So let's say that you leave the account alone and it continues to earn that 6% per year. By the time you reach 85, even if you never put another dollar into it after the first 10 years, you'd have nearly $300,000. And plus, since you made your contributions to a Roth IRA, that entire amount would be tax-free. Pretty solid. Still, if you still think that just $7,000 a year can't make a difference, I think you're seeing that it actually can. And just to think, if you're married and you were able to make that $7,000 contribution to both your Roth IRA and your spouse's Roth IRA, you'd have twice as much tax-free. That starts to really roll up and become a really powerful tool as you're saving, as you are finishing out your career. Now, if you're still working and you have access to one or more plans through your current employer, you might be able to do even better. So while the limits on contributions can vary depending on the type of plan your employer offers, you can generally contribute more to your company plan than you can to an IRA. So, for example, here in 2022, you can contribute up to $20,500 of your salary into a 401k or a 403b or a similar kind of plan. Those are all just IRS codes for an employer-sponsored retirement plan. If you're 50 or older by the end of the year, then you can contribute an additional $6,500 as a catch-up contribution, which actually, if you're over 50, brings your total potential plan contribution annually to $27,000. And depending on your plan's provisions, you might actually be eligible to receive employer contributions, like a company match or profit sharing contribution. So as you can imagine, putting this type of money away, even for just a few years, can have a huge impact on your retirement savings. And plus, provided you meet the requirements that we talked about a little bit earlier, you can make a contribution for your IRA or Roth IRA on top of your company contribution, company plan contribution. So, of course, at some point you're likely to retire, and when you do, you're going to be faced with one of your first major retirement decisions, which is what to do with the money that you've accumulated in your employer-sponsored retirement plan. In many cases, people will choose to roll their funds over to their traditional IRA or their Roth IRA because the traditional and Roth IRAs tend to offer greater control over your retirement funds and your retirement choices. They're not the only options, though, and those rollovers aren't always the best move. Believe it or not, you might have as many as 6 different options for your employer-sponsored retirement plan funds when you decide to leave work. And I have them up here on the screen so you can see them. Each of these potential alternatives offers unique benefits, but there are drawbacks as well. So it's usually a good idea to discuss your options with a professional advisor so you can make the savvy decision that's right for you or right for your family. And this is where advisors here at Ford Financial Group or professional CFP can come in. And if you're not working with somebody to help you with these options, you can always email us at info@fordfg.com, or you can email your Ford Financial Group advisor directly. So getting money into your retirement accounts is only the first half of the story. Coming up with an efficient way of taking those funds out and avoiding costly mistakes is the other half of the battle. And this is far easier said than done, particularly when it comes to your traditional IRAs, 401ks, 403bs, and other pre-tax retirement accounts. In general, withdrawals from these accounts are taxed at ordinary income rates, just like interest. So your withdrawals are added to your income and taxed at whatever tax bracket you happen to find yourself in at the time. If your overall income is relatively low, you might have a low tax rate for your withdrawal. Now, on the other hand, if your overall income is high, your tax rate is going to be higher, and more of your IRA withdrawal will end up in the hands of Uncle Sam. So here's a quick look at the tax brackets for single and joint filers in 2022. One of the troubling aspects of IRA planning is that the tax rate on your future distributions is unknown. Even if you can project your income with relative confidence, there's no guarantee that tax rates will remain the same. And while it's hard to find someone who doesn't think they pay too much taxes now, the reality is that the top tax rates today are actually pretty low if we look at them in a historical context. So take a look at this chart to see what I'm talking about here. When the income tax was first introduced in 1913, the top rate was only 7%. But within just a few years, the top rate had already skyrocketed to over 70%. And then after dropping back down to as low as 25% after World War I, top rate jumped again to 63% in 1932. And then from there, it wasn't until more than 50 years had passed when in 1987, the top tax rate finally dropped down below 50%, letting those in the top tax bracket keep more of their income than they were forced to give Uncle Sam. Now, of course, not everyone's paying that top rate. In fact, it's only a very small percentage of taxpayers that do. But that said, with our national debt at all-time highs and a budget that hasn't been balanced in years and fiscal troubles for many of our entitlement programs like Social Security and Medicare, it's possible that these rates go up across the board, which makes coming up with the right plan even more important with that kind of uncertain tax future for all of us. To make matters even worse, your IRA withdrawals can cost you a lot more in ways than just adding to your income. They can always also cause you to be phased out of itemized deductions, personal exemptions, and other various kinds of tax credits. They can increase your exposure to the 3.8% surtax on investment income. If you take an IRA withdrawal, you might actually have to include more of your Social Security benefits in income, and in your Medicare Part B premiums can increase. And so that's just the beginning. If you want to avoid these kinds of issues, you need a plan for your withdrawals. And one way to minimize the tax impact of retirement account withdrawals is to avoid taking the withdrawals altogether. That allows your retirement money to grow tax deferred and keeps that nasty taxable income off your tax return for as long as possible. But you can't wait to put off your withdrawals forever. At some point, you've got to do it. And that point now is at age 72. Because once you turn age 72, the law requires you begin to take what are known as required minimum distributions. They're known as RMDs for short, and these come from your traditional IRA, not your Roth. And the same rules generally apply to employer-sponsored plans like the 401ks and 403bs also. RMDs are simply the bare minimum you're required to take out from your retirement account each year to satisfy the tax code's rules. Essentially, you've struck a deal with the IRS and said, I'm gonna defer on taxes, and they say, okay, but you can't leave it in there forever, and you need to take a minimum amount out at age 72. And if something about RMDs at age 72 sounds a little weird to you, don't worry. It does sound weird, and it's because RMDs generally began once you reach 70 and a half. For a very long time, that was the rule. But as you might be able to guess, this is another one of those changes that were made right at the end of 2019 through that Secure Act that I mentioned a little bit earlier. So one final thought here before we move on. Remember that you can always take more, but if you fail to take at least the minimum amount from your traditional IRA, the IRS can actually hit you with a 50%, that's 50% penalty for any amount you should have taken, but you didn't. So to calculate your RMD, you need to know two things. You need to know your prior year-end balance and your life expectancy factor. Getting your prior year-end balance is usually pretty simple. In most cases, you can just look at your December statement or the end of the fourth quarter statement and use the ending balance. Then you use your age to look up your life expectancy factor on a table provided by the IRS, and you divide your prior year-end balance by that factor. So sounds complicated, but let's give an example here. Suppose you're calculating your 2022 RMD. The first thing you need is your prior year-end balance. So let's imagine that your December 31st, 2021 IRA balance was $200,000. So that's part one. Next, you've got to figure out your life expectancy factor. Most IRA owners use what's called the Uniform Life Table to calculate their RMDs. So if you look on the screen here, I've given you some of the life expectancy factors. So let's imagine you turn 75 this year. Now we simply go to the table and look up the factor for a 75-year-old. And as you can see here, the factor for a 75-year-old is 24.6%. So to determine your RMD in this hypothetical example, we divide $200,000 by 24.6, and we get $8,130.08. And then each successive year, you do the same thing. You take your prior year in balance and divide it by your new life expectancy factor. So not as hard as it seems, right? Pretty easy to figure out. And of course, most people don't think about things in terms of factors or life expectancies. So this is a chart that I think you'll find helpful. It shows the approximate percentage you're going to need to take out of your IRA from age 72 to 91 in order to steer clear of that 50% penalty I mentioned a little bit earlier. If you'll look, you'll see that each year the percentage you need to take out increases. It doesn't necessarily mean you need to take out more money each year than the last. It also depends on how much your IRA gains in a year or loses, for that matter, from year to year. But it's a percentage of that year-end number that continues to grow as you get a little bit older. Now, RMDs can actually get much more complicated, and as we've already talked about, the penalties for making a mistake can be pretty severe. So with that in mind, let me tell you about 3 of the most common RMD mistakes people make so you can avoid them and not make them yourself. Remember, part of any savvy IRA plan is minimizing the costly mistakes as much as it is anything. So one common RMD mistake that people make is incorrectly aggregating their RMDs between different types of retirement accounts. So for example, you have a 401k and an IRA, and after calculating your RMDs from each account, they come out to be $4,000 and $3,000 respectively for a total of $7,000. Now imagine your IRA is earning at a higher rate of return than your 401k, so you might be tempted just to pull the $7,000 out of your 401k, leave your IRA alone, call it a day. After all, what's the difference here? Well, they're both retirement accounts, and whether you take $7,000 from just your 401k or $4,000 from your 401k and $3,000 from your IRA, it's all the same impact on your tax return. And that's pretty logical thinking, but the tax rules are anything but logical, and they specifically prohibit you from doing that. An RMD for one type of retirement account, like an IRA, can never be taken from another type of retirement account, like a 401k. Another common RMD mistake is aggregating RMDs between spouses. For instance, suppose you and your spouse file a joint tax return and you have an RMD for your IRA of $4,000. Your spouse has an RMD for their IRA of $2,000. Just to make things easy, you simply take $6,000 out of your IRA. After all, they're both IRAs. You filed jointly. Income's going to show up on the same return, right? Well, that may be true, but it doesn't matter. Retirement accounts are individual accounts. So there's no such thing as a joint IRA or a joint 401k. So you must always take your own RMDs from your own accounts. Now, a third common RMD mistake is forgetting to take an RMD altogether. This should never happen, but sometimes mistakes happen, and it's just a fact of life. Maybe a family member was sick, you got preoccupied, you're not working with an advisor who maybe caught it for you. You're away on your dream vacation, maybe, and it simply slipped your mind. Whatever the reason is, if you forgot to take your RMD, or if you otherwise made a mistake, the one thing you should not do is forget about it and pretend that it never happened. In most cases, if you do that, the IRS can come back and assess that 50% penalty, along with a host of other penalties and interest indefinitely. One strategy to minimize the impact of taxes on your retirement savings is to avoid taking distributions from your IRA for as long as possible. This allows your retirement money to enjoy its favorable tax-deferred status for as long as possible. It also keeps the income off of your return, which you've already learned is not only helps keep your income tax bill lower, but it can prevent increases in other costs tied to your income as well. There are some major downsides, though, to this approach. Most notably, as your IRA gets bigger, so does your problem. Think about it. If your tax bracket remains about the same over time, and then as your IRA grows, so does the amount you eventually have to pay Uncle Sam, maybe through the required minimum distribution. Now, this is much different from other things that you might be used to. For instance, imagine you bought a house for $200,000 and you have a $50,000 mortgage. If the house doubles in value to $400,000, does your mortgage increase to $100,000? No, of course not. You get to reap all the benefits of that appreciation, but that's not how it works with an IRA or 401k or other similar kind of tax-deferred account. If those accounts double in value, you don't get to keep all the gains. Uncle Sam is going to get his share. So plus, by waiting to take distributions for as long as possible, your RMD, your required minimum distributions later, will be larger, right? Because it's a percentage of a larger account. And this could actually increase the impact of some of those side effects that we've talked about. Thankfully, there's a way to fix this. So to go back to the mortgage analogy for a moment, you can own your IRA free and clear so that only you benefit from the appreciation. It's called a Roth IRA conversion, and it's the next item on our IRA planning strategy here. A Roth IRA conversion is the name given to a special type of transaction where you move money from your pre-tax retirement account, like an IRA or 401k or 403b, to a Roth IRA. When you make a Roth conversion, the amount of money you convert is added to your tax return for the year and is taxable at whatever income tax bracket you happen to be in. So, for example, let's say Jill has $100,000 in a traditional IRA and would like to convert it to a Roth IRA. We'll talk about why she might want to do that in a moment, but if Jill moves forward with a $100,000 Roth IRA conversion, she'll have to add $100,000 of her income to her tax return for the year, which will be taxable at whatever rate Jill happens to be at. It might even bump her up to a higher rate. And because this is a big decision and can have significant impact on your taxes, it's always best to discuss this option before you pursue it with your tax advisor and your financial advisor that you're working with. So why would you voluntarily choose to make one of these Roth IRA conversions and pay taxes before you have to? Well, there's a lot of reasons, but perhaps the most common reason is the one that we've talked about already, which is to pay off Uncle Sam now so you own your retirement account free and clear. So remember, with a Roth IRA, you have the potential for future tax-free withdrawals of everything in your account. So if you're over 59 and a half and you've had any Roth IRA for more than 5 years, then all withdrawals from any of your Roth IRAs will be tax and penalty free for life. If you're over 59 and a half, but you haven't had a Roth IRA for 5 years yet, you can still take money out of your converted amount, tax and penalty free, at any time. If you're younger than 59 and a half, other rules apply. Probably not the right choice for you. Something else to keep in mind is that unlike Roth IRA contributions, there are no restrictions on who can make Roth IRA conversions. So you can't be too old for this one. You can't be too young for that matter. You can be working, you can be retired. There's no minimum amount of income you need or maximum amount of income that you can have. So I think you see where I'm getting at here. If you want to convert your IRA to a Roth IRA, there's nothing in the tax rules that will stop you from doing so. You just need to do the math, do your homework, and make sure it's the right choice for you by working with an advisor and your tax professional. The potential tax-free nature of the Roth IRA might also provide you with additional benefits, like a hedge against tax rates that could be rising in the future. And when it comes to your retirement, there are a lot of unknowns. What's the market going to do? What's inflation going to be like? What will your tax rate be? So on and so on and so on. So that last one, taxes, is a major concern for many retirees. And one we've kind of covered a little bit already. A Roth IRA conversion can help manage that risk by paying the taxes now at today's known rates. And if rates rise in the future, tax-free distributions from a Roth IRA will be even more valuable than you had originally planned. Now, of course, if you think your tax rate will be lower in retirement, then that would be an indication that this strategy is not right for you, right? If you are at the top tax bracket right now, and you will be at a lower tax bracket when you retire and you aren't earning money, then maybe the conversion it's not the right time for the conversion. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact other things tied to your income like we discussed earlier, like Social Security and Medicare. Another big benefit of the Roth IRA, and one that many retirees actually find attractive, is that the Roth IRAs have no RMDs, or required minimum distributions, during your lifetime. And remember all those RMD calculations we were talking about, mistakes that could be made that we talked about earlier? They're not an issue if you have a Roth IRA. During your lifetime, you can take as much or as little as you want from the Roth. You're not forced to take anything at 72 if you don't want to. And that means your Roth IRA can continue to grow and compound tax-free for your heirs, which also might make it a pretty intriguing vehicle from an estate planning perspective if we're handing this on to our heirs. The Tax Cuts and Jobs Act, however, eliminates the recharacterization option for conversions made in 2018 and later. So if you convert your Roth IRA now or in the future, you're stuck with that decision. You can't go back and change it later. So that was another update that came from some laws here in the not too distant past. Even if your tax bill is higher than you thought, or if the conversion accidentally phased you out of a credit, or if your investments dropped in value, no matter what the reason is, you can't recharacterize that conversion, meaning go back and undo the conversion. Once it's done, as you can see on the slide, too darn bad. So with that in mind, it's important that you're absolutely sure that you want to convert your Roth IRA before you actually do it. So here are 3 questions to ask yourself and maybe talk about with your advisor before you convert. Do you have a rough idea of the conversion's impact on your tax bill? That's number 1. Number 2, do you have a plan to pay the resulting taxes? Number 3, do you have a reasonable expectation that the benefits of prepaying your taxes like this are going to make sense in your overall plan? You should be answering yes to all of these questions if you're going to do a Roth conversion. So here's a savvy conversion strategy that might be helpful for you. It's called filling up the bracket strategy. So remember all those tax brackets we looked at a little bit earlier? Well, sometimes you can find yourself in the middle of one of them with room to add more income without pushing yourself into one of the higher tax brackets. So, for example, in 2022, the 22% tax bracket for married couples filing a joint return the window is about $83,000 to $178,000. Okay. So with that in mind, suppose then that you're going to file a joint tax return. Your taxable income is a nice round $100,000. That means you could add another $78,000 of income without going into the next bracket. Making a Roth IRA conversion of that remaining amount could make sense for you. So if you plan to convert a sizable portion of your IRA, this approach is often more tax efficient than converting the full amount all at one time. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your tax bracket each time. And this can actually help reduce the average tax rate you're going to pay on the converted money and also spreads the tax bill out over a longer period of time. Roth IRA conversions can be especially useful if you've had a low income year. So for example, if you're a business owner with unusually low sales in a year, like COVID, for example, or are you paying high non-recurring medical bills, or maybe you're retired but not yet receiving Social Security benefits or pension benefits or IRA distributions. These are all questions to ask to see if a Roth conversion could be a good move for you at this particular time. And of course, these strategies aren't for everyone. And if you can see here on this slide, there's no guarantee that a Roth conversion is going to achieve the intended results. This is the good old, we can't predict the future kind of slide. So let's look at savvy strategy number 3, because there's a good chance that at some point during your life, you're going to want to move around some of your retirement money. Maybe it'll be done as a part of a Roth conversion. Maybe it'll be to make a new investment, maybe to work with a new advisor. Whatever the reason, you should be aware of how to move retirement money so you don't make a costly mistake that could derail your retirement. In general, there are 2 ways you can move retirement money. You can either move it indirectly, which is known as a 60-day rollover, or you can move it directly via a direct rollover or a trustee-to-trustee transfer. Moving money directly is usually the savvy choice, meaning moving it directly from one institution to another as opposed to having it sent to you and then you deliver it to the other new institution. So first, let's take a look at indirect rollovers that we began with. In an indirect rollover, you receive a distribution of your retirement funds payable to you, or they're sent to a non-retirement account. Then you have 60 days from the time you receive your distribution to get it back into another retirement account. And if you miss the 60-day deadline, the distribution is taxable, and depending on your age, it may be subject to an additional 10% penalty. So even if you're on top of things and you complete your rollover within 60 days, there are other additional problems with indirect rollovers. So for instance, if your withdrawal is coming from an employer-sponsored retirement plan, like a 401k, the plan generally has to withhold 20% of your distribution for income taxes. Congress wants to make sure you don't take your retirement money, run away, and never pay the taxes that you owe. A separate, troublesome rule applies to the 60-day rollovers from IRAs. If you're moving your money to another IRA, only one of these rollovers can be done per year. So if you try and make a second 60-day rollover, chances are the entire amount will be taxable. And that same rule applies to Roth IRA rollovers. So as you can see, there's some real problems with indirect rollovers. Thankfully, there's a generally better way to move your retirement money. And direct rollovers, like I mentioned a little earlier, or they're also known as trustee-to-trustee transfers. Your money is sent right from your old retirement account to your new retirement account, and there's no 60-day time limit to worry about, no mandatory 20% withholding, and there's no one rollover per year rules to be worried about here. Typically, this is done by providing you with a check made payable to your new custodian. So if you work with us, often the check's been made payable to LPL Financial, care of Ford Financial Group, with your account number may be listed if you're rolling it over from a 401k or 403b. So an example, like you can see here on the check, it's the check could read Company X Custodian for the benefit of, or their FBO is another thing that could say John Smith IRA in this example. If the check's made payable to your new custodian, where the new home is for the rollover, your distribution can still qualify as a direct rollover and get that same favorable tax treatment. There's no 60-day deadline, no mandatory withholding. And that's true even if your plan sends you the check and you forward it to the new custodian because it's made out to Company X Custodian for the benefit of you and your IRA. Another essential component of any savvy IRA plan is to make sure that you coordinate your IRA planning with your overall retirement. You want to, with your retirement, your estate, your tax, your education, your financial planning goals. Your IRA and other retirement accounts can impact each of these areas, and it's important to factor all of the elements of planning, not just the investment management or the IRA planning. So if you're watching this, some of you may have all of your savings in retirement accounts, but many of you probably have some of your savings in an IRA, a 401k, and the like, and then you have other separate savings in what's called non-retirement accounts, or like an individual account or a TOD trust account, perhaps. If that's the case for you, one savvy strategy you may want to consider is coordinating your IRA with your overall plan, and then carefully selecting which of your investments are purchased with IRA money and which investments are purchased with non-retirement account money. Doing that and working with your advisor to do that could help you to meaningfully lower your tax bill. So here's an example of what I'm talking about. Let's imagine you have $100,000 in an IRA and $100,000 in a non-IRA account. And then we'll also imagine that you want to purchase $100,000 of bonds with a hypothetical interest rate of 4%, which a while ago was inconceivable and is now actually doable. And then you're going to do $100,000 of stocks that'll pay you hypothetical qualified dividends of 4%. Now, also assume that you plan to live off the income these investments generate and that you're in the 24% tax bracket. So here we go. These are our assumptions that we're working with as we go through this. Now, in the first scenario you see here, all of the stocks are purchased inside the IRA account and generate $4,000 of qualified dividends. In general, qualified dividends receive special tax treatment and are taxed at long-term capital gain rates. These rates are lower than ordinary income rates. However, because this investment was made inside an IRA and all withdrawals from an IRA are taxed at ordinary income tax rates, if you take a withdrawal of the $4,000 of qualified dividends, they're still going to be taxed at your hypothetical 24% ordinary rate. And this results in a tax bill of $960. Now, in the same scenario, you have $100,000 of bonds also generating $4,000. Bond interest is taxed as ordinary income too. So that means you'll owe another $960 of tax on that income. Brings your total tax bill, you can see here, to $1,920. So in the second scenario, we buy the bonds inside the IRA. They generate the same $4,000 of interest as before. And if taken from the IRA, will be taxed at your hypothetical 24% rate. This gives you the same $960 tax bill for your interest as you had before. Now, on the other hand, we're purchasing your stocks with non-IRA money, and your qualified dividends are taxed at long-term capital gains rates in this scenario. So your ordinary income tax bracket is 24%, and you'll have a 15% tax rate on long-term capital gains. So now, under this scenario, your tax bill on your qualified dividend drops to $600, bringing your total tax bill to $1,560. That's a $360 difference compared to the first scenario, and a tax savings of nearly 25%. Now, in both scenarios, you invested exactly the same amount of money in exactly the same investments, and you took exactly the same investment risk. However, in scenario 2, what we're looking at right here, you get to spend an extra $360 just because of your savvy planning and straddling the investments between the two different kinds of accounts. So when it comes to your investments, it's not just what you own, but also what matters is where you own it. And of course, you have to be aware that anytime you're dealing with investments, this is the we can't predict the future slide. There's no guarantee they're going to perform as expected. And while we don't anticipate the special tax rate for long-term capital gains to be eliminated anytime soon, it does get talked about from time to time. There's no crystal ball to predict what the heck Congress is going to do in the future. So just be aware of that. Now, another way your IRA planning needs to be coordinated is with your overall investment retirement plan and your Social Security claiming strategy. The decision of when to file for Social Security is one that far too many retirees make without thoroughly evaluating their options first. And this is one major mistake, and one that in some cases can cost you more than $100,000 of income over the course of your retirement or course of your lifetime. Now, the decision of when to claim Social Security I understand it is a very personal decision and one that varies significantly from person to person and couple to couple. Now, with that said, many retirement experts today believe that too many people claim Social Security too soon. I am one of those people. I am one of those experts. Don't claim Social Security too early. Remember, Social Security benefits are guaranteed to last your entire lifetime, no matter how long you live. And benefits are generally increased from one year to the next through cost of living adjustments. Right now, we have some pretty high inflation, which suggests the cost of living adjustments this year will be much, much higher than the historical average. And so by delaying receiving Social Security benefits past what's called your full retirement age, which is 66 or 66 in a few months for most of you, it can allow you to earn an additional 8% increase in payments each year until you turn age 70. And that's what's known as deferred credits. For those reasons alone, and there's some others, it's beneficial to claim Social Security benefits later than you had initially planned for. Anything else, if you said there's a guaranteed 8% more if you wait 1 year, I think many people would say yes. But I understand you've got to eat in the meantime, right? And so that might require you to pull money from your IRA in the interim to help cover your current living expenses. Retirees sometimes opt not to do this because they say, well, what if I die early? I'll have spent my IRA money, which takes away from my heirs, and I've gotten little or nothing from it. And while it's something we want to, life expectancy is always something we want to consider. There's kind of two reasons why you might want to give that approach a second thought. First is that a 2012 report from from the Center for Retirement Research at Boston College concluded that Social Security is one of the cheapest, if not the cheapest, annuity available. And it sounds kind of funny. After all, you don't buy Social Security, right? In a way, though, you kind of do. If you use IRA money to hold off on claiming Social Security for, say, a year, that's the kind of price that you pay to get the higher benefit. If you compare that price and increased benefit to what you can get from commercial annuity providers, for example, it's almost always cheaper. And then another reason it can make sense to draw from your IRA in order to help delay claiming on Social Security benefits is that Social Security benefits are generally more tax efficient than IRA withdrawals. Now remember, when you take an IRA withdrawal, the entire amount is generally added to your income and taxed at whatever rate you happen to be at. In contrast, Social Security benefits may be anywhere from 15% tax-free all the way up to 100% tax-free. So the key point is for you here is that trading $1 of IRA income on your tax return for $1 of Social Security benefits will almost always leave you with a lower tax bill and more money to spend. Okay, time to move on to the next savvy IRA planning strategy, and that's coordinating your IRA planning with your estate plan. Because in most estate plans, there are really just two primary goals. First, make sure your assets pass to your intended beneficiaries, and secondly, that they're passed to them as efficiently as possible. When it comes to IRAs, 401ks, and other retirement accounts, that's done with one form in particular, and that's the beneficiary form. And I really can't emphasize how important this form is, and yet, time and time again, people fail to update these forms after major life events like births, deaths, marriages, and divorces. Many times people think that because they've updated their will, everything else is magically taken care of, and that's just not the case. So for example, if you have your ex-wife or ex-husband named on your IRA beneficiary form, but your will has been updated to say all your assets go to your children on death, take a guess who's going to end up with your IRA. Yes, you guessed correctly, your ex. And I can't tell you how often this happens to people. That's why it's so important to keep updated copies of your beneficiary forms with all of your other important estate planning documents. And I can tell you here at Ford Financial Group, when we're working with your estate planning attorney, we make sure we're communicating those things between our two offices. Now that you understand the importance of the beneficiary form, I want to take a second here and talk a little bit more about IRA beneficiaries. Any person or entity can be an IRA beneficiary, but there are different post-death withdrawal rules depending on the type of beneficiary you select. Broadly speaking, there are three main types of IRA beneficiaries after the Secure Act. There are non-designated beneficiaries, designated beneficiaries, and eligible designated beneficiaries. And as you can probably guess by looking at this slide right here, non-designated beneficiaries generally have the worst tax treatment, and eligible designated beneficiaries generally have the most favorable tax treatment. So you might be thinking to yourself, shouldn't I just make sure all my beneficiaries are eligible designated beneficiaries? And unfortunately, in many cases, it's just not possible. At least if you want to make sure that specific people get your life savings. So for instance, let's take a look at the different types of eligible designated beneficiaries here on the slide. Certainly, no one's going to hope that their beneficiaries are disabled or chronically ill. And if you don't have minor children now, and it's highly unlikely you're going to have one in the future, the trusts you see there are generally only trusts where the beneficiary is another type of eligible designated beneficiary, such as a disabled person. So that doesn't work, which leaves you with beneficiaries who are not more than 10 years younger than you are, which generally won't apply if you're leaving your IRA to your siblings or friends or spouses. If you're married, chances are your spouse is your beneficiary. But when that second death occurs, who will your collective retirement funds be left to? In many cases, it's going to your adult children, and that's who falls in that middle blue category. So let's take a close look at the rules for post-death distributions for each of these categories of beneficiaries. So let's start with the group of the beneficiaries that generally has the most unfavorable treatment. And these are non-designated beneficiaries. This group is comprised of beneficiaries that have no life expectancy and includes beneficiaries such as your estate and charity. So as you can see here, the rules for how quickly money must be distributed from an inherited account after death depend on how old the owner of the account was when they died. In many cases, that means such beneficiaries must distribute the entire inherited account within 5 years. This can lead to big lumps of income that get taxed at much higher rates than an owner may have paid during their lifetime. Next, let's move on. We have the designated beneficiaries category here. If you've named children, grandchildren, nieces, nephews, or other kind of similar close family members that aren't your spouse as your IRA beneficiary, there's a good chance they're going to fall into this category of IRA beneficiary. In the past, this group of beneficiaries was able to take advantage of something commonly known as the stretch IRA. And that's where distributions from the inherited account could be spread over an individual's life expectancy. And this allowed the tax benefits of the retirement account to last as long as possible and be kept taxable income. You keep the taxable income each year to year at a minimum. Well, unfortunately, the Secure Act, which is the same law from 2019 that I keep bringing up here, eliminated the stretch tax benefit for regular designated beneficiaries. So now, instead, this group of beneficiaries has to distribute the entire inherited IRA by the end of the 10th year after they inherit. Now, this new 10-year rule isn't as bad as the 5-year rule we just went over, and that hits the non-designated beneficiaries, but it's a far cry from the decades that some children and grandchildren and so on had to spread out the distributions before the Secure Act was enacted. The stretch IRA was a really powerful tool. So for those of you who expect to pass on large retirement accounts to heirs, you should be particularly mindful of this change because it might influence planning decisions during your own lifetime, like how much, if anything, to convert to Roth IRAs. The new 10-year rule is effective for most IRA beneficiaries and plan beneficiaries, and it began in 2020. Now, I will finish this slide with a note. Exceptions exist for governmental plans, collectively bargained plans, and certain qualified annuities where the lifetime income option was irrevocably selected prior to 2020. So if you've got one of those and you want to talk about your more specific situation, I would say email us at info@forwardfg.com. So finally, we get to the brand new type of beneficiary created by the Secure Act, eligible designated beneficiaries. Eligible designated beneficiaries are the only beneficiaries left who are, wait for it, eligible to stretch distributions using the rules that were in place before the Secure Act was passed. And as we talked about this before, it's a pretty limited list. It really doesn't help many of the people who you plan to eventually leave your retirement assets to, your adult children or other people who don't fall into one of these categories here. And this is what it means to stretch IRA distributions. Eligible designated beneficiaries and only eligible designated beneficiaries are able to take minimum distributions calculated over their IRS-provided life expectancies. The stretch IRA then is just the name that practitioners have given the strategy to a beneficiary taking only the minimum amount of inherited IRA each year that it's required by law. In doing so, it helps an eligible designated beneficiary minimize their income tax and maximize tax deferral of the inherited account. In contrast, all other beneficiaries typically have to withdraw all inherited IRA money much sooner than these eligible designated beneficiaries. One question we get asked a lot is whether or not a person should leave their IRAs to a trust. And trusts are certainly good at providing post-death control. And if that's a real concern of yours, it's certainly something for us to talk about with your estate planning attorney and consider. But naming a trust as your IRA beneficiary adds considerable complexity to your estate plan. And if drafted properly, trusts can be treated as designated beneficiaries and preserve the stretch IRA. All too often, however, they do not meet the specific requirements outlined by the IRS, and they end up having to follow less favorable rules for non-designated beneficiaries. And even if they're drafted properly, trusts come with certain costs, such as the cost to prepare the trust itself, the cost for filing annual trust, income tax returns, and accelerated taxation of any IRA withdrawals that are held inside the trust. So ultimately, naming your trust as your IRA beneficiary is a very complicated matter and is something that should be carefully considered and discussed with your full team of advisors. That includes your tax advisor, CPA, estate planning attorney, and your financial advisor, whether it's us or somebody else. Many people, though, name their spouse as the beneficiary of the IRA. So let's just pause for a second and talk about this. If your spouse is your sole IRA beneficiary, then he or she will generally have several options after inheriting your IRA, and they include choosing to remain a beneficiary of your account, as well as making what's known as a spousal rollover. So I want to address each of these items here quickly in a little bit more detail. So one option a spouse has is completing a spousal rollover. And in a spousal rollover, the surviving spouse takes the deceased spouse's IRA and moves it right into their own IRA. And a spousal IRA rollover is an irrevocable decision that once completed, these funds are treated as though they were always in the surviving spouse's IRA. And generally, this is the best option for spouses who inherit at 59 and a half or older. Another option available to spouse beneficiaries is remaining as a beneficiary of the inherited account. This is generally the preferred option if a spouse inherits prior to turning 59 and a half, because it allows them to take penalty-free distributions from the inherited account regardless of their age. Where in contrast, if they were to make a spousal rollover, the money would be treated as their own, and distributions taken prior to age 59 and a half would generally get the 10% early distribution penalty. So if you're a spouse beneficiary and you inherit prior to reaching age 59 and a half, you can remain a beneficiary until you reach 59 and a half, and then at that time, execute the spousal rollover. And in fact, more often than not, that's the best approach. So if there are other special rules that apply to spouse IRA beneficiaries, again, talk to the financial advisor. But these are very, very useful, pretty clear strategies that you can use to maximize the efficiency and the benefits coming from beneficiary IRAs, and just IRAs generally for that matter. So with that, we've come to our last savvy IRA planning strategy. It's one you should all know about, but for whatever reason, people seem to forget, and that's to always do your homework before making any decisions with your IRAs, especially when it comes to your investments. IRAs are often the target of schemes and scams because, let's face it, that's where a lot of people's savings are. And I know it, but you know who else knows it? The scammers. They know that the money is there. So in recent years, the SEC has issued alerts warning certain IRA owners that they may be targets of scams, and the IRS has even put out a publication with the title, "The IRS Does Not Approve IRA Investments." And that's done in a response to many fraudulent promoters claiming that their IRA investments were somehow given the green light by the IRS. At the end of the day, it comes down to the golden rule. If it sounds too good to be true, it probably is. Your IRA may represent a lifetime's worth of work and savings. Don't squander it by making a foolish decision, and don't get scammed out of it. We have gone for quite a while, and we've covered a lot of ground today, and you should have plenty of food for thought from some of the points that we've covered. And you've probably realized at this point, if you're still watching, that IRA planning is a lot more complicated than most people realize. Let's face it, deciding what strategies are best for your IRA crosses into just about every area of planning. Tax planning, investment planning, estate planning. There are few retirees are aware of just how critical IRA planning is, and even fewer have taken the time to truly evaluate all of the issues and develop a comprehensive solution. So hopefully I've helped answer some questions for you in this slide deck, but chances are you probably still have some others. I know when my wife and I go to meetings, when we finish the meeting, we're halfway down the street, we look at each other and say, "Oh, there was that thing that we forgot to ask." But that is okay, because at Ford Financial Group, we're here to help answer your important questions, evaluate your financial picture, and develop a savvy IRA planning strategy to help figure out what's best for you and what's best for your family. So I appreciate you watching the full hour of this presentation and joining me. I will encourage you, if you have questions as a result of this presentation, you can email us at info@fordfg.com, and we can respond to your questions or connect you with a financial advisor to help answer those questions for you. So thanks again for watching. Stay tuned for more of these recorded presentations to help you make good financial decisions.